Mercado Libre just got crushed after earnings. The stock fell 12% in a single day, and investors immediately started asking the same question. Has the company finally hit a wall? So I went through the report, the margins, the fintech business, the e-commerce growth, and the long-term numbers. And honestly, I think the story here is way more interesting than most people realize. So let's start with the earnings report itself, because there were a few key numbers that completely changed how Wall Street viewed the quarter. And overall, the quarter was actually pretty solid. Mercado Libre delivered a massive revenue beat, coming in about 6.3% above expectations. But despite that, earnings per share missed estimates by roughly 2.9%. And that EPS miss was one of the key reasons why investors reacted so negatively to the report. But outside of the EPS miss, the underlying numbers were actually very strong, in my opinion. Unique active buyers grew 26% year over year. Gross merchandise volume was up 36%, which is still an astonishing growth rate for a business at this scale. Items sold increased 47% year over year. Same and next day shipments grew 39%. And another strong metric from the report was items sold per unique active buyer, which increased 16% year over year. So when you put all of this together, the conclusion is pretty clear. The marketplace segment remains extremely strong and is still growing at a very rapid pace. And the fintech segment also delivered very strong numbers. Monthly active users grew 29% year over year, which is still an impressive growth rate at this scale. The credit portfolio increased 87% year over year, an absolutely exceptional number. And total payment volume grew another 50%. Continuing the company's very strong momentum in fintech. So overall, the conclusion here is very similar to the marketplace business. The fintech segment remains extremely strong and is still growing at a remarkable pace. Altogether, commerce net revenues increased 39% year over year, while fintech net revenues grew another 54%. Yes, we are starting to see some growth deceleration in fintech, but these are still absolutely exceptional numbers for a company operating at this scale. So if the growth was this strong, why did the stock fall 12%? The answer is margins. Operating margin came in at just 6.9% this quarter, compared to 12.9% a year ago, a very significant compression. Net income margin also declined sharply, falling to 4.7% versus 8.3% last year. And according to the company, this margin pressure was largely driven by aggressive investments into long-term growth opportunities. We can clearly see that in the numbers. Income from operations margin declined by roughly 600 basis points, while net income margin fell around 360 basis points year over year. And ultimately, this is what scared investors. The market is starting to worry that Mercado Libre could be entering a phase where the company prioritizes long-term investment and expansion over short-term profitability, something we've seen before with companies like Amazon. But personally, I don't think this quarter changes the long-term story in any major way. Because when you look beyond the margin compression, the underlying business still appears exceptionally strong across both e-commerce and fintech. So with the earnings report out of the way, let's zoom out and talk about the bigger picture, the business itself, the competitive position, and whether Mercado Libre still deserves its premium valuation. Right now, Mercado Libre is a company with roughly an $83 billion market cap, and this is definitely not a cheap stock. The company currently trades at around 43 times trailing earnings. If you look at price to free cash flow, the valuation appears much lower, around 7 times free cash flow. But in Mercado Libre's case, that metric can be somewhat misleading, since the fintech business now represents close to half of the company's total revenue. So the real question here is not whether the stock looks optically cheap. The real question is whether Mercado Libre actually deserves this premium valuation. And to answer that question, we need to look at one thing first: growth. Because Mercado Libre is not just a fairly valued company. It's a company that has been growing at an absolutely extraordinary pace for a very long time. Over the last 10 years, revenue has compounded at around 46% annually, which is honestly unbelievable for a company of this size. And what's even more impressive is the consistency. Year after year, growth has typically stayed above 30%. Now, looking forward, analysts do expect some deceleration over the next couple of years. But even then, the expected growth rate is still above 20%. Which is, in most contexts, still extremely strong. When it comes to margins, we are seeing a slight decline across the board. And the main reason is pretty clear: Mercado Libre is heavily reinvesting back into the business. We can also clearly see a significant increase in CapEx, which signals that the company is continuing to aggressively expand its infrastructure and long-term capabilities. But the key question for investors is not the level of investment itself, it's the return on that investment over time. Because right now, margins are not particularly strong compared to historical levels, and there is still a meaningful amount of room for improvement. One of the most interesting parts of Mercado Libre's financials is the gap between ROIC and ROE. ROIC is around 10%, which tells us that the underlying business is still solid, but not extremely high return, especially because the company is heavily reinvesting into logistics, fulfillment, and credit expansion. But ROE is much higher, around 36%. And this gap is important because it shows that shareholder returns are being amplified by the financial structure of the business, mainly through Mercado Pago and its credit operations. That's why ROE looks exceptional, while ROIC is much more grounded. So if we put everything together, we get a pretty mixed but interesting picture. On one side, we still have very strong underlying growth, both in e-commerce and fintech, with the business continuing to scale at impressive rates. On the other side, we are clearly seeing margin compression driven by heavy reinvestment into logistics, infrastructure, and credit expansion. So the key question now is what kind of returns investors can realistically expect from here. So in the next part, let's run a simple sensitivity analysis and see what the potential upside or downside could actually look like under different scenarios. For the revenue assumptions, I'm mainly using analyst estimates as a baseline. And based on those expectations, I think a 19% revenue CAGR in the bear case, 21% in the base case, and 23% in the bull case over the next 5 years is fairly reasonable. For net margins, I'm assuming at least some improvement by year 5 as the company scales and investments mature. So I use net margin assumptions of 8%, 9%, and 10% across the 3 scenarios. As for share count, Mercado Libre currently isn't meaningfully diluting shareholders, but the company also isn't aggressively buying back stock. So I modeled a 0.5% annual increase in share count in the bear case, 0% in the base case, and a slight 0.5% reduction in the bull case. And when all of these assumptions are combined, they translate into expected EPS CAGR of roughly 25%, 31%, and 37% across the bear, base, and bull cases. When it comes to valuation assumptions, I do expect some multiple compression over time. As growth gradually slows and Mercado Libre becomes a more mature business, I don't think the company will continue trading at the same premium multiples forever. So for the exit PE assumptions, I use 26 in the bear case, 30 in the base case, and 34 in the bull case. And based on those assumptions, the expected annual returns from today's price come out to roughly 13% in the bear case, 22% in the base case, and just over 30% in the bull case. And honestly, those returns still look very attractive to me considering the quality and growth profile of the business. Now, when it comes to my required return assumptions, I usually target around a 15% annual return and apply a 10% margin of safety on top of that. And under those assumptions, I get an entry price of roughly $2,000 per share, which is still meaningfully above the current price. Even if I increase the required return to 20%, the valuation comes out to around $1,600 per share, which is still roughly around today's price level. So overall, I think the current setup looks very attractive. And if we look at the broader sensitivity table using a PE range between 25 and 34 and EPS growth between 24% and 33%, the outcomes still look pretty compelling across most scenarios. Even in the more conservative cases, expected returns are still around 11% annually, which is already slightly above long-term market averages. And if the company executes somewhere closer to the base or bull case, the potential returns move into the 20% plus range, which is obviously very strong for a business of this quality and scale. So at least from my perspective, the overall risk-reward here still looks very interesting. So overall, I think the market reaction makes sense to a certain extent. The stock didn't fall 12% for no reason. Investors clearly got concerned about margin compression, rising investment intensity, and the possibility that profitability could remain under pressure for longer than expected. But at the same time, when I look at the actual business underneath all of that, I still see an exceptional company. The marketplace segment remains very strong. The fintech business is still growing at an incredible pace. Revenue growth continues to massively outperform most large-scale companies globally. And most importantly, Mercado Libre still appears to have a very long runway ahead of it. So personally, I view this pullback more as a potential buying opportunity than a sign that the long-term story is broken. Because in my opinion, Mercado Libre is one of those businesses that can still work extremely well as a long-term buy-and-hold investment. And as we saw in the valuation model and sensitivity analysis, the potential returns still look very attractive across a wide range of scenarios. So overall, this is definitely a company I'm interested in buying and probably will be buying, because the current setup looks very compelling to me. Anyway, that's it for today's video. If you enjoyed it, feel free to leave a like and subscribe. It really helps the channel a lot. And as always, thank you for watching.